Like a no-brainer, right, David? But before you buy into the ETF market, we've got someone who says there are 3 very important tips every investor should know before buying. So Tom Lydon, Global Trends Investment CEO, joins us now. So let's get into it. Tom, what are these 3 tips to keep in mind before you go ETF?
Right, Lori. Well, first, it's important to understand 99% of ETFs are meant to mirror an underlying index. Well, you can not only get the price of that ETF, but also every 15 seconds, you can get the price of that underlying index. So comparing the price of the index to the price of the bid and ask spread of that ETF is very important to make sure you're paying the right price.
One of the things, by the way, that jumped out at me is that you never buy at the at-market price. You always set a limit order on these things because setting it at market really puts yourself at risk of losing a better deal than you could get.
That's right, David. Again, ETFs trade like stocks. The market makers set a bid and ask spread. You're at the mercy of the market makers if you set a market price. So understand what the underlying index value is, and then you're able to set a limit order based on what that value is.
How do you understand that underlying? How do you get the details of the ETF?
Yeah, the details of the pricing of the underlying index is called the indicative value. In most cases, you can put the ticker symbol of the ETF and then a .iv and get that underlying index value. In some cases, you can go directly to the website of the ETF providers, and they'll give it to you regularly as well.
Okay, so explain the difference, or rather, why you may or may not prefer an ETF over a mutual fund.
Well, there are a lot of reasons. First of all, you know what the underlying index is. It's transparent. The tax efficiency that are there. It's liquid. There's a lot of shares traded in and out. And most importantly today, it's the fees. With the average actively traded mutual fund or actively managed mutual fund charging 120 basis points or 1.2%, and the average ETF charging 25 basis points, that's a huge difference, especially when 8 out of 10 actively managed mutual funds underperform their benchmark. So today, you've seen, just in the last year, close to 140 billion leave actively managed mutual funds on the equity side, and you've seen over $1 trillion in the last 3 years go into bonds, bond-related funds, and ETFs. People don't have confidence, and in these market conditions, ETFs provide a little bit more transparency for a lesser fee and more confidence for advisors.
All right, let's talk about some of these ETF bond funds. And we've got a range from the most risky, which not surprisingly are called junk. In fact, it's the symbol, the ticker symbol is JNK for junk. That gives about a 7.5% return. That's extraordinary. All the way down to a more conservative investment-grade corporate bond fund, LQD. So describe these different funds. Sure.
Well, the whole premise here, David, is junk isn't the way junk used to be. Corporate America is actually in pretty good shape. They're sitting on $3 trillion in cash. But JNK and HYG have lower grade corporate bonds, and they're offering some pretty attractive yields at these prices with a lot less volatility. So when money market funds or treasuries are paying pitiful rates, here's a way to make very attractive yields on the corporate side. If you want high quality, LQD provides very high quality corporate bond returns for over 4%. Very attractive. Again, not saying put all your money market money in there. There surely is volatility, but you surely can enhance your yield too by just put in a small portion.
Well, Tom Lydon, thanks for the free seminar on ETFs. Appreciate your time and your analysis. Tom Lydon is with Global Trends Investments. He's the CEO.
Thank you, folks.
Have a good weekend.
This is information I may use.